a growing number of economists are warning that the U.S. stock market may be following in the footsteps of past market crashes. Despite rising stock prices, economists say today's AI bubble and other factors are fueling similar fears that led up to past economic downturns. Joining us now with charts to help break this all down, former Treasury official and Morning Joe economic analyst Steve Rattner. And Steve, your first chart takes a look at how the rising stock prices we are seeing today compared to past markets right before a major financial crash. Tell us about it.
Sure, Mika. Now, look, first of all, I'm not here to predict stock prices or crashes or anything else. Predicting market is kind of a fool's game. Nobody can really do it well. But there are some things going on that are certainly worth pointing out. The first of them, as you said, is the rising stock prices. If you look over here, you can see that in the last 6 months through October 8th, the stock market had its best 6 months since 2000 for any 6-month period, rising 36%. And that's part of why people are talking about this. Now, why is the stock market going up? It could be a bubble. We're going to talk about a couple of other things, but there's also a fair degree of optimism around AI and the fact that corporate profits have been quite strong as companies are using AI to cut costs and things like that. So there are people who believe fundamentally the stock market is on sound footing. But if you look at the stock market compared to other peak markets, it does look pretty scary. So this is what we call the price-earnings ratio. It's how we measure how expensive stock prices are, the ratio between the stock price and how much the company is actually earning. And you can see here that at present, we're at 39, which is well above the 50-year average right over here of around 23. And so I've shown you 3 other similarly expensive stock markets. The global financial crisis, at 28. Now, that was not as much a stock market crisis initially as a banking crisis, so a little bit lower. The famous dot-com bubble, the last time we were in a situation like this, of course, it was the internet we were talking about. And then, thanks to Andrew Sorkin, whose terrific new book is out, #2 bestseller on the New York Times list, and he's drawing the analogy to 1929, when it was only at 33, actually a bit less expensive. There's certain other adjustments. 1929 was a long time ago, but the market was expensive. What happened after those high prices? The stock markets all dropped pretty precipitously. 56% after the 2008 financial crisis, 49% after the dot-com bubble, and a stunning 85% after 1929's crash.
So, Steve, one of the other warning signs you're looking at a potential bubble is retail trading. Can you explain what that means exactly?
Yeah, sure. And this also bears relationships to 1929. What it means is the stock market is normally dominated by institutions, sophisticated institutions doing fundamental analysis. At times in the past, and perhaps at present, you have retail investors coming in, individuals who are out there sort of playing the stock market game, if you will. And so I'll show you a couple of examples of how that's happening. This is the overall S&P here, going up as we talked about. But here's a Goldman Sachs basket of retail stocks. They found a bunch of stocks that these individuals are focused on. Companies from Palantir, which is a defense company, Micron, which makes semiconductors, Hims & Hers, which is an online pharmacy, Warner Brothers Discovery, and they calculated how those prices have done. And you can see they've way outpaced the general market because they've become what we call meme stocks, individuals piling in. Another measure of this are options. Options are when you take an option on a stock. If a stock goes up, you can make a good bit of money. But if the stock doesn't go up, or if it goes down, you can lose all your money. So it's a kind of a leveraged, highly risky bet on stocks. These are retail. Again, these are individuals, not institutions, and what they're doing. And you can see that retail options volume has taken off. There are over 100 million options traded the other day, only the second time in history when over 100 million options were traded by retail investors.
Wow. And your third chart looks at this sort of rush to gold.
Yeah, so stocks may not be the only bubble that's out there. You've got a few other things happening that are really pretty amazing. One is gold and silver. I'm showing you gold here. It's hit a record price of about $4,500 an ounce. It's come down a little bit the last few days, but it's still way up here. Why is this amazing other than this? Because gold usually tracks interest rates. The higher the interest rates, the lower the price of gold because it's more expensive to hold. This red line is interest rates. It's inverted, so down is higher actually, just to make this clearer. And you can see how closely they were tracking. Now they've become disconnected. Why have they become disconnected? A lot of reasons. After the Ukrainian invasion, when the world froze Russian assets, a lot of central banks said, we better hold gold because other stuff could get frozen. But the other reason is uncertainty. Gold prices also track uncertainty pretty well. And so right now, we got a lot of uncertainty for all the reasons we well know. And so we have high gold prices. And it's not just even gold and silver. Bitcoin is up 60% over the past year, another speculative bet that a lot of people are making. So there's a lot of speculation in the market. There's also some fundamentally good things like AI happening. Where that goes, anybody can bet their own money on.
So, Steve, as you just mentioned, Andrew Ross Sorkin's book, 1929, is a compelling history of who, what, and how 1929 occurred, how the crash occurred. But isn't today drastically different given all of the support systems and regulatory systems that have been implanted into the economy? That's
a really good point, Mike. And one of the points Andrew makes in his book is that the initial stock market crash was actually not that big a deal. The stocks actually went up for a while, and then eventually they turned way down. And why did that happen? Because we didn't know how to respond to that crash, unlike in 2008, which was relatively short-lived. And so we didn't have the Federal Reserve cutting interest rates and putting money in the system and creating liquidity. And you're absolutely right. We made a lot of policy mistakes back in 1929, which had a lot to do with why it was so much worse, not just the stock market, but the whole depression, than I think anything we're realistically facing today.
Morning Joe economic analyst Steve Rattner, thank you very much. And